So now we're going to go part two of chapter 15, and the main focus on this is going to be regulation, specifically the Affordable Care Act, and also consumer options. So how can you get health insurance, or what avenues do you have available to you as a U.S. citizen to get health insurance? And again, that is the coverage for health care, because we want to keep in mind we're separating the idea between health care and health insurance. They're not the same thing. Okay. All right. So let's start off with very very interesting topic, at least to me. Specifically, a lot of my research focuses on this, and that's the Affordable Care Act, or the Patient Protection and Affordable Care Act, or Obamacare. So this was something that was, pretty contentious, a decade ago or so. Opinions on it are changing a bit to be slightly more positive, at least public opinion is. So basically what happened is there's this huge dramatic shift within healthcare itself, but a lot of these kind of transitions and changes were focused in the health insurance industry, and that's kind of where we're going to be for the remainder of this chapter once we kind of get the basic ideas ironed out. So there's one thing about this law that was not upheld, and that was Medicaid expansion. That was left to the state's choice. As of right now, there are about 11 or 12 states that have not opted to expand Medicaid. We'll cover that a bit later as well. Okay. Now, so what about financing the ACA? So basically, when you want to offer more healthcare coverage, or you want to try to do something that kind of fundamentally shifts the privatized nature of a market, money has to come from somewhere. So some of it's through taxes, some through fees, some through penalties, right? And it's not that, it was supposed to be cheap, right? The initial cost budgets by the CBO were around 1.7 trillion. Now it does look like it's going to be a little bit less than that. Right now, costs attributed to the ACA are around 1.4, 1.5, and it doesn't look like it's going to increase steadily. Now, a lot of that does have to do with states not opting to expand Medicaid, because within that expansion, a good portion of the money was actually coming from the federal government and not the states. So therefore, when states opt out to not expand Medicaid, the federal government is not, shelling out cash to those states. So that had a little bit to do with the fact that we're not hitting that 1.7 trillion estimate. Okay, and to give you an idea, so healthcare expenditures in the U.S. for 2019 were around $350 trillion. So this seems like a lot of money, but it's kind of a drop in the bucket based on how much we do actually spend in this market. Okay, and you can go back to the part one for a little more discussion on the cost there. Right, so let's shift into the health insurance changes. So again, this regulation did more than just change health insurance, but it probably changed health insurance more so than it did provider side things. Okay, so the first one we're going to talk about here is coverage reform. So examples of coverage reform. So these are selected examples, not every change. The first is the individual mandate. Now, what's interesting about this, and something that's good to think about from an insurance market perspective, is we have a mandate, and what this means is you're mandated to purchase health insurance or some form of insurance. If we require the potential insureds purchase insurance, there's no choice for them. They have to buy it. So there's no selection. If there's no selection, there's also no adverse selection. So from a pure market perspective, this is pretty intriguing and maybe ideal if we can completely not only just mitigate but completely circumvent any adverse selection whatsoever. That would be wonderful. That would be wonderful. Now, there are a number of dissenters who say, well, what if I don't want to purchase insurance? Right? It's not like a car. I can just choose to not drive a car, and if I don't drive a car, I don't have to purchase insurance, right? So people want it to be a little more discretionary, and that was one of the big arguments against the mandate. And that could be understandable. There's some people who don't see the cost benefit, or the benefit for the cost of health insurance. So that's understandable. Now, in 2017, the IRS said, hey, we're not going to go through every list and see who doesn't have health insurance to charge them the penalty. So after that, it was kind of like, why even care? And then in 2019, or really 2018, but effective in 2019, the Trump administration basically just dissolved the individual mandate. And actually, as of right now, there's a case going up to it's Texas versus a few other states, and they're saying that, well, since the mandate is not constitutional, then the whole law is not constitutional. And they were just recently shot down by the Supreme Court because, that's a bit of an asinine kind of claim to make, and they tossed it quickly. But anyway, the mandate is as it is, or is no longer as it is. But I want you guys to keep in mind again, if we say everyone has to purchase insurance, there's no selection, therefore there is also no adverse selection. So from a market perspective, that sounds great. Okay. Other changes: retention of coverage until age of 26. So dependents have coverage under their parents up until that age of 26. Prior, there was nothing like this, whatsoever. And this isn't terrible, right? Because yeah, it's extended coverage and it's going to cost a little bit more, but most people under the age of 26 are healthy and therefore not quote unquote bad risk. Okay. Now the next point: lifetime limits and pre-existing condition exclusions. So these are really pushed by consumer advocacy groups, but the thing is, a lot of um, health insurance products already had this. Not all, not all. Now lifetime limits tend to be pretty high. $500,000 to $1 million. But if you have cancer or some other kind of disease or illness that has kind of a long tail, or you could live 5-10 years after and it's still expenses coming up, then yeah, you could definitely hit that. Also, rescission and denial of policies is prohibited. So rescission is going back and noting that there's a problem in the original application and saying, oh, there's a problem in this application, so we're gonna drop you from this, so we're gonna rescind this policy. Denial is just like underwriting. You're saying, oh, you're a bad risk, so I'm not going to offer you this. You can no longer do that. You can price people out of the market. And in fact, later on in this same video, we're going to go over and look at some of the exchange plans, and you can see that plenty of people probably would be priced out of this market. And then we have guaranteed access to health insurance. The exchanges are actually quite good for this. Whether they're good for finding affordable care is up to you to decide. And then finally, it's more specific with health insurers. So another push of the ACA was from consumer advocacy groups again, saying that health insurance companies, are just making money hand over fist, so we need to limit their profits. So what they've done is said, well, we've already talked about loss ratios, so they tell health insurers that the loss ratios have to be above a certain level, right? So they can't make essentially more than about 15% direct underwriting profit just on loss ratios, right? So what we have seen is a bit of a drop in profit margins across health insurers, but not too much. Health insurers in the last 10 to 12 years have averaged margins of around 1 to 2%. So there you had it, profit margins of 1 to 2%, but that seemed to be somewhat arguably problematic, at least in some groups' eyes. So you can click on this little short link here for a little more information. Okay, so this is just for again, your information here. All right. So the exchanges. So we're going to come back around to this, and we're actually going to go through an example when we look at consumer options. So the health insurance exchanges, the idea here is they're going to create a competitive and transparent marketplace that people can just go and shop for health insurance. Okay, it's not, well, even now, but especially 10 years ago, it wasn't like shopping for auto insurance or homeowners or renters insurance, which is actually quite easy to do. Health insurance was, a whole different bag and far more convoluted, and not just because of health insurers. Healthcare itself is frankly very convoluted and not that easy to navigate. So the exchanges were set up to make at least the insurance, the shopping side of it, a little bit easier. Okay, now it's still, this has nothing to do with you actually being able to see the true price for an MRI or a CT scan. Who knows how much it actually costs. It can vary by, geographic location, provider, institution, network, in, out of network. This is simply focused on offering health insurance for individuals. Now, so I said transparent and competitive. We'll see that these are actually, I would argue, very transparent. It's very easy to shop for plans, especially now we're actually in open enrollment. Today is the last day of open enrollment, so very fortuitous that we get to go over it today. So we can actually shop and look at these plans. Now, competition. Now we can measure competition in a few different ways. We can look at price elasticity. We can look at the number of the number of players in the game, so to speak, how many firms we have. We can look to see how high the barriers entry may be. And if we kind of combine all that, it's very hard to argue that these are truly competitive markets for the simple fact that a lot of markets, in this case, based on the state or the county, have 1 to 2 insurers. So you don't really kind of meet that qualification of having actual competition by number of firms operating, number of sellers. With price elasticities, these plans are relatively expensive. I would argue that it's probably only people who really need the health insurance that are going to buy it. So, the price elasticity and the demand, it's going to be hard to say for the most part. So, there's just not a lot of evidence to suggest these are competitive marketplaces. They're not great. Um, However, again, we do have that transparency. What helps that transparency is the way these plans are set up and making it easy to shop. So they're based on ratings levels. Now, each of these plans here from bronze to platinum are related to the actuarial value. So think about when we talked about expected loss, right? And we talked about, well, what's the actuarial value? What's the pure premium for this plan, right? So the closer you get to that pure premium, the higher the actuarial value. The closer you get to paying out to that full expected loss, the higher the actuarial value. Now, as you would expect, as you go from bronze to platinum, yes, the coverage is better. Your deductibles will be lower. Co-insurance that you pay might be lower. Co-pays might be lower. Out of pocket will be lower. But the premium is much higher. A platinum plan, frankly, I've been doing this for 3 or 4 years. I have never seen a platinum plan. I'm sure they're offered in some larger cities and municipalities, but I've never seen a platinum plan. But from a bronze to a gold plan, the premiums can almost be twice as much. And in fact, the example we're going to see today, I think it will be a little more than that. Now, what we need to note here from an underwriting perspective, we can base these based on age, where you live, and whether or not you smoke, and that's it. So keep in mind, one of the things that we want to really try to do in a good insurance market is keep the underwriting as open as possible. Meaning that when we start putting these restrictions on that, then our underwriting accuracy or the ability to underwrite is greatly diminished. The less or the more difficult it is to underwrite, the more difficult it is to create equity in rating, the more difficult it is to control against adverse selection. All right, so this is just a quick overview again of the whole competition thing, right? So we have competition and transparency. You can just read over this. So right now we have about 2 in most areas in this state. As of 2019, so this was last year's enrollment period, 26 states had less than 3 providers. So it's hard to say that that's really competitive, and the premiums have continued to increase, though they've stagnated a bit the last couple of years. But when you're talking about $500 or $600 a month in premiums, I guess they got to stop somewhere, right? Okay. Now, let's move into options for consumers. So you might find yourself, now or after the age of 26, or if you're, taking a new job, with some options. So how could you go compare and contrast? So we're going to go through employer options, the exchange options, which we just talked about, and then maybe other options as well. Okay, so this would be more private and on your own. Now, 9 times out of 10, the employer options are going to be better because it's group based. And when you have employer based or group based health insurance, there are a lot of advantages that come from that. Okay, so employers often offer health insurance as part of a benefits package. In fact, this is probably, if you take my employee benefits class, you'll note that this is probably one of the most, at least in the recent years, the most demanded employee benefit. So 55% of all plans are employer based. This is in the U.S. It's about 0% outside of the US. It's funded through joint employer-employee contributions. So employee benefits can really comprise almost 30% of an individual's actual compensation, right? So if you make $50,000 a year, your employers might be paying up to $15,000 for health insurance premiums, retirement plan package, and other types of pecuniary benefits on the side, or kind of ancillary benefits. Okay, and the employers kind of select and provide some options to employees, usually at least a couple. From a risk management perspective, if you're an employer, you want to offer options, because if you just give everybody one plan, those few people that don't like the plan are going to throw it back on you, whether it's a good plan or not. If they don't like it, they're going to throw it back on you. Whereas you can give them, your employees, a couple of options, and even if they choose the bad option, they'll feel better because they have some locus of control and that autonomy. Even if they chose the wrong plan, they still chose it. Okay, so risk management perspective, employers want to offer at least one health insurance plan. Okay. Now, the good thing is these contributions are tax deductible, and we'll talk about other tax advantage plans at the end here with health savings accounts. So what does this look like from an insurer perspective? So I said that employer plans are already kind of grouped and pooled. So what does this mean from a markets or an insurance company's perspective? So a couple of benefits here. We get pooling and some reduction of adverse selection. Now, what I mean by that is if we have an employer that has 500 employees, we have a pool. We already have a pool. Not only do we already have a pool, we have a group of individuals that probably have not come together just to find health insurance. They probably have come together because they wanted that job. Now, I'm not saying that there's no one who takes a job because they want health insurance. In fact, I think that's a false statement. There are some people who get a job just because they want health insurance, and there's nothing wrong with that, and it's very much understandable. But if we have 500 people, the chances of all of them, or even 50, or even 20, or 25 going into this job just to get health insurance is very low, which means that they are not selecting into this pool just for the sake of getting insurance, meaning that we have a reduction in adverse selection. Whereas I would say 90+% of people who are going on the health insurance exchanges that we're going to see in a bit, they're going on there, let's just say 100%. 100% of them are going on there just to find health insurance. Why else would it be that? Now, when we go look at it, it's going to be an academics, perspective. It's going to be an academic exercise. So it drops down to 99% when we're going to go look at it. But otherwise, most people are going there just to find health insurance, which is a selection issue. We don't see that as much with group-based plans. So you might say, well, this sounds great. Why don't we just go back to this? This is what we had before. It was working, right? Not so much. So some of the arguments is, number one, you have to have a job. Okay. And then sometimes what would happen, people with big health issues can't get a job because of those health issues. So there's this kind of, you're damned if you do and damned if you don't, right? So these plans are also heavily subsidized by the employer. So the employees may not even see the actual cost of their health insurance. It could be that they're covering 60 to 70% of it, and by law they have to at least cover half. So employer payments kind of insulate that true cost. On top of that, self-employed people don't really get these benefits. If you're self-employed, you're not a group. Okay, so it's very difficult to get commercial group insurance if you're self-employed. Now, if you have a large firm, you have 50, 60 people, sure. If you have less than 50 people, you can get some tax credits and things like that. Okay, but so it's not all well and good. If you have a good job, then your health insurance is probably pretty solid, and you're paying less in premiums, relatively speaking, to someone who's going on and purchasing private insurance. Okay, now, so the exchanges, I've been kind of hyping these up, maybe hyping up and knocking down a peg or two as well. Again, keep in mind, transparent and competitive. So what did these marketplaces look like? So what I want to do is I want to shop around. Let's say we take someone, in their late 20s, early 30s, so relatively healthy from an RMI perspective. And let's say that they're looking for health insurance and they're in this area. Okay. All right. So we should see this plan here load up. So we're just going to say that they live around Muncie, at least in the county. We have their zip code. Okay, now keep in mind the things we want to think about, how transparent is this and how competitive. is this market. So what's happening now, this is like online underwriting. Okay, this is exactly what's going on. They're trying to see about this individual. So let's say that this individual again is looking for health insurance. So what's about their household? Okay, so it's just one person. Okay, let's say that they are in their, let's say late 20s, 29 maybe, so they won't have coverage on their parents. Let's say it's male. Now they can actually underwrite on whether they're male or female, so this shouldn't really change. They're not eligible anywhere else. They're male, so they're probably not pregnant, and they don't smoke, so no tobacco. Okay, so none of these. Now the next thing they're going to ask is income. Now median per capita income for the zip code here is around $33,000 as of 2019, and I have a quick little reference to that if you'd like to see it. So that's what we're going to use. We'll just say it's an even 35,000. Okay, and this is household income. Okay, per capita would obviously be a little bit lower, and these incomes, especially in an area like this in the Rust Belt, there's a decent disparity, and there's a tail on the right hand side for sure. Okay. All right, so this individual is eligible for a $73 premium cut. So whatever the premium is, so if it's $300, we're only going to pay around $225 and some change for it. Okay, so $73 off. Okay. All right, so what do these plans look like? Okay. Well, the first one here, we have everything sorted by premium. So this is our cheapest plan. So this is someone who makes $35,000 a year, and the cheapest insurance plan that they could find on the exchanges, let's just say it's an even $200 per month. So they're paying $2,400 per year. Okay, well, how good is it? Well, it's a $7,700 deductible. So that means that, if we recall from previous work, the policy is not going to pay anything out until this person has already paid $7,700 for a plan that's costing them $2,400 a year. So that's essentially, let's just say $10,000 that this person has spent. And if we get to the out of pocket, it might be a little bit more, around 11,000 or so. But let's say $10,000 this person already spent. Well, if they're making $35,000 a year, that's their gross. Their net income is probably going to be around 26, 27. And while these are all tax deductible, your expenses are tax deductible, that's still roughly a after tax $8,000-9,000 hit after we kind of take out the appropriate deductions. So this individual is paying essentially a third of their overall yearly pay if they or before the insurance even kicks in. Okay, so including the premiums and the deductible, they're already paying out a third of their income before the insurance even kicks in. So this is really kind of indicative of a market that just has really, really high underlying severe risk. So, if this person goes and gets an MRI and a CT scan and then maybe sees a specialist, they've probably hit the $7,700 deductible. So it doesn't take much. So while it does seem expensive, it's not necessarily because there's a problem with the underlying insurance product. It's just that the risk, in this case, the cost of healthcare, is so exorbitantly high, or I won't say exorbitant, but so high compared to other lines of business. Okay, so like automobile insurance or something like that, homeowners, renters, the severity is not always as high. Okay, so this, you can make up your mind as to whether this is a good plan or not. We have this sorted by premium, so let's see what the most expensive plan would be. I'm gonna guess, so we're looking at 200, 208, let's just say $200, and that's with the $73 credit, by the way. So $200 per month, about a $7,700 deductible. So let's go to the last page here. I don't see an easy way just to skip to it. I'm gonna guess it's gonna be close to $500 for the most expensive plan. 497, very close, very close. Okay, now this plan, all right, so we pay, let's just round it up. We rounded the other one down, let's round this one up. We're paying $500 a month, so that's $6,000 a year, but we have a deductible that's significantly lower, about a seventh of the original deductible at $1,150, and the out of pocket is half, so $4,450. So when I look at a plan like this and compare it to the other one, I would assume that the only people purchasing this plan are those who really know that they're going to need insurance. In other words, it's an adverse selection story that we have there. Now, can we prove that? I mean, not sure, but all roads kind of lead to one thing here. So very, very expensive, very expensive. So this would have normally been $570 per month, and for someone making 35, $1,000 a year, pretty difficult to handle that. Okay. All right. So those are the exchanges, at least in this area. Now, I would assume that in larger cities, if we went close to Indy, or definitely, if we went like LA or New York or something like that, there'd be far more plans. Now, that being said, I'm seeing a few different. So I'm seeing Ambetter. Um, let's see. Just trying to see if there are more. I think it's just one. Yeah. Looks like there's just one insurer. So it's hard to say that's competitive when it's just one insurer. That being said, noticing the losses in these markets, if I were a health insurer, I would not want to operate on the exchanges. I wouldn't want to touch the exchanges. So that there's even one here is pretty impressive. Okay, so that's enough of naysaying on the exchanges. Something I didn't focus on enough, right? Because it's not all bad. It's not. Something I didn't focus on enough. It was very, very easy for us to shop around in those plans. I was just kind of being a little flippant with it and moving through everything, but it's very, very easy to shop around for those plans. Far easier. I would say it's probably even easier than shopping around for car insurance. Because if you're looking for car insurance, you're going to have to go check a few different websites. You'll get emails from Progressive, from State Farm, Geico, whatever, and then you'll have to go to each of their individual websites. But with the exchanges, you have it all right there in front of you. Now, whether or not it's competitive, whether or not it's truly affordable, I mean, I think it's not difficult to argue no on those two, but it is pretty easy to argue that it's transparent and easy to shop around. Okay, so keeping in mind, how transparent are they? I would say fairly. And we could look at the deduct or the basic declarations page and see a few things about it. All online. Is it easy to navigate? I would say so. How affordable and how competitive? That's up in the air. I think it's very difficult to say they're affordable and or competitive. I mean, we have one. We have Ambetter, and that's it. Okay. All right. So what about other options? Like, well, I'm not employed. Or if I am employed, if I don't want to, use the exchanges, or I don't want to use my standard kind of health insurance, what do I have? Okay. Now that being said, if you look for plans not through the exchanges, they're very difficult to find. Um, and in fact, for another academic exercise, I contacted my one of my broker friends and asked them what they could get for me, just as an example. And everything that he sent me back was just something I could find on the exchanges myself. So it's pretty difficult to get a plan outside the exchanges that doesn't comply to those rules. Okay. Now, so you can get to those intermediaries, and just a little brief example here. But something that I want to kind of end on, if you find yourself with an employer that offers a health savings account, more often than not, that's going to be one of the better healthcare plans that you can get. Not always. It's not a one size fits all. I'm not saying that you need to always get an HSA. It might not be the best option for you, but for many individuals, it is. So what is an HSA? So HSAs are tax deductible savings accounts, essentially. There are some eligibility requirements that are offered through employers. They're paired or mated with a high deductible healthcare plan. Now, what's good about this is HSAs kind of have what are called the triple tax advantages. One, as you're paying into the HSA, you're not taxed on the money you put in. So if you put $100 in that HSA, it's pre-tax. Two, any qualified medical disbursements that come out of your HSA account, you're not taxed on. So if you put $100 in there and say withdraw to pay for a doctor visit, and it's $100, you're never taxed on that $100. And this makes sense because most of your medical expenses are tax deductible anyway. And then finally, the third advantage is that the interest accrued, so it's a savings account, the interest accrued is not taxed. Okay, so it's very similar to like a 401k plan. And again, if you take my employee benefits class, we'll learn all about those. Okay, so HSAs are pretty good deals. I have one Definitely use it for sure. And the thing is, even if you don't use the money that's in a health savings account, it just keeps accumulating over time. So if the end of this year, if I don't use anything in my HSA, that's fine. I have that money for next year. I can keep contributing. My employer will also add a little bit of money into it. Okay. Now you can only put about 30 this year, $3,600 into an HSA, but that for most people, myself included, that's more than enough to meet the deductible and covers most of the out of up to the out of pocket and or the co-insurance. Okay, so they're really really good plans. Now, flexible spending accounts are very, very similar. The differences are that they do offer a little bit of dependent coverage that you won't see with HSAs, um, but you don't get to keep that money. So with an FSA, it's if you don't use it, you lose it. Okay, so the funds don't roll over with an FSA. So for most intents and purposes, not all, but most intents and purposes, an HSA is going to be a little more desirable than an FSA. Some people will opt to use both of them. They're more risk averse than I am. Okay. So what do you get from it for a health savings plan? So it reduces healthcare costs. You do pay because you're paying out of pocket. You feel how much it costs. So you're not saying, oh, the insurance company will just pay for it. Now you do have an insurance plan obviously paired with this, right? So you have a high deductible health insurance plan that's paired with this, and you use your HSA to pay up to the deductible and then the co-insurance. You can also roll an HSA over into a retirement account, or you can keep your HSA funds until you retire and you can contribute to them up until age 65. And then after that, you can still use them. You just can't contribute to an HSA after 65 because then you're on Medicare. But it's still your money. You still have it. And you can roll it over from different jobs. In fact, one of the biggest providers of HSAs is just called HSA Bank, and they offer about 60 to 70% of the HSA funds in the U.S. And most any employer is going to go through HSA Bank. So as you move, you still have that same kind of card with HSA Bank. Now it's not all perfect. Okay, so the reason this is cheaper is often just because the deductibles are so much higher. That's not as true now as it was 10 years ago. The HSA that I utilize, the deductible is only $500 higher per year than the plan, the standard plan that's offered. So, it's not that big of a gap as it was 10 years ago. Though to be fair, what is now considered a standard health plan has deductibles that are above what were considered high deductibles 10 or 15 years ago. Okay. HSAs are usually better for low risk individuals, so younger people, for sure. I mean, that being said, once you've accumulated enough into the HSA, even if you're having to pay out your deductible most every year, well, if it's only $500 extra a year and you have the tax advantage of the HSA and it's accumulating and your employer's adding to it, I mean, HSAs are not bad. They're not bad. And then shopping around, you're not gonna find anything on the exchange that's gonna really be this good. Now it's very difficult to get HSA on your own, if not impossible. These are almost always offered through employers. Okay. All right, so that gets us to the appendix there. That just has some sources and references to some of the claims that we've discussed and some of the numbers we've discussed before. All right, so keep in mind, kind of the things I want you to be aware of, kind of the changes of the Affordable Care Act, mostly with coverage and some underwriting limitations. And then be comfortable with how the health insurance exchanges operate. Obviously, I won't expect you to recreate all of that in the exam setting. Okay, but just know that with the exchanges, yes, it's pretty easy to argue they're transparent, but it's far more difficult to argue that they're competitive or affordable. And then we have this kind of hit here on what HSAs and FSAs are, and I'd like you to just be able to kind of delineate between those two accounts, HSAs and FSAs. Okay, thanks. Have a good day.